My name is Letitia, and I'm coming to you from ABC Taxation Consulting Group. And today, my colleagues and I will be presenting a tax case. Our client's name is Mrs. Delby. We will be computing with you line by line and going through detailed explanations of how we came to net income for tax purposes as well as taxable income for 2016. So the first thing that we need to look at is under subdivision A. We need to look at her annual salary. And in the case, we're told that her annual salary is $143,000. And we're also told that there's no commission income involved. So that's perfect. We just put in here $143,000. Our next line is we're going to look at her bonuses. For 2016, we're told that Mrs. Delby earns $34,500 worth of bonuses, but only 2/3 of that amount will be included in her 2016 pay. So that's the portion that we need to look at for her employment income. So in her employment income, we only include 2/3 of that total amount, $34,500, which brings us to $23,000. The next line is we need to look at our car payments from her employer leased vehicle. Whenever you have an employee leased vehicle, you have two charges to consider. First being the standby charge, and the second being the operating cost benefit. So first we need to look at her standby charge. Because Mrs. Delby uses more than 50% of her kilometers is for business rather than personal income, we can use the reduced standby charge. So our calculation would be as follows. It would be 2/3 times our monthly lease payments, tax included, minus the insurance coverage of $50, times the number of months that the vehicle was available to Mrs. Delby, in this case it's 11, times her personal kilometers, in this case 15,000, divided by the denominator of 1,667 kilometers, times again 11, the number of months the vehicle was available. The next line would be our operating cost benefit, which is the lesser of two calculations, as you can see here. The first is just 50% of our previously calculated standby charge, which would be $2,033. And the second calculation would actually just be her personal kilometers. In this case, again, 15,000 kilometers times 26 cents, which brings us to $3,900. And of course, very clearly, the lesser of these two amounts is $2,033. So I'm going to pass it over to my colleague, and she's going to continue to explain to you free interest employee home loan benefit.
Hi, my name is Elham Farrahi. Let me continue Ms. Delby's case for her income tax return for 2016. The next concept that we are going to consider is her loan. She has received a loan from her employer, which is interest-free loan. The ITA says if employer provide employee with a low interest or interest-free loan, this loan will be taxable benefit. However, if the loan is to assist employee in buying a home to get the employee closer to their workplace, at least 40 kilometers, and there's a deduction for this taxable benefit. But here, there is no deduction because she is not relocated. She's staying at the same neighborhood, so we cannot have any deduction for her. We just need to add the amount of loan, which is 250,000 in her income, and then this benefit is calculated. This benefit is calculated as the interest on the loan at the prescribed rate minus any interest actually paid on the loan within the year or 30 days after the year end. And the other things we should consider, the document that she provided us shows that she has received several gifts from her employer. The ITA says if the employer gives you a gift or reward, it should be non-cash, and the amount should be less than 500. In this case, the gifts or reward will be free of tax. But here, there are several kinds of gifts. The first one is employers, senior staff. She received a $400 gift certificate. The amount is less than 500, which is good, but it gives certificate. It's almost cash, and we consider gift certificate as a cash. So we have to include this amount in her income. And the next one is she received a watch as a gift. The amount of the value of this watch is $1,200. It's non-cash gift, but it's the amount is more than 500. The government says the ITA, the Income Tax Act says, let me show here, if the gift is more than $500, the exceed of 500 is taxable. So we can deduct $500 from the 1,200, and then this 700 we will add to her income. And the last one is Christmas gift. It's a basket food items with a value of 300. The amount is less than 500, and it's completely non-cash, so she's safe here. So we don't have to do anything with this gift. Thank you so much.
Good evening, my name is Pedro Dominguez, and I'm going to continue explaining Section 7 and Section 8 related to the Mills Building Income Tax 2016. First of all, we have stock option in Section 7, and stock option benefits that we included because she received benefits from a public company. At the moment that she granted the option price, it doesn't have any tax consequence, but at the moment that she exercised all the shares, she have a benefit that we have to include. And we use the calculation at the moment to determine the amount that she has to include in her income tax. First of all, we have the fair market value, less the price paid and the auction price, and multiplied by the total auctions, and we have the fair market value at the moment there is, she exercised all the auction was 45 less 37 in the price auction, and we multiply by the total auction, so we have $9,800 that included in her income from employment. Next, we have the Section 8. In the Section 8, we only have a professional due in employment, registered pension contribution, and meals. For the first one, we have we use the section according to the Section 8 of the income tax. So we included the amount, the whole amount for this purpose, and also we include $6,400 for the she contributed the employer registered pension plans. In the meal, we have $2,650. We included was the day period they're using the 50% of the amount that she paid. So she paid $4,800 less $9,500 that she reimbursed for an employee, and the difference multiplied by the 50%, it is amount for deduction of $2,650. The total employment income for each employment was $173,800 because she doesn't have any other income from property or business and other deductions. So we have a net income in the Section B for the same amount that we for each employment. In the Section C, we have a special case for employee stock option. She cannot claim the amount because the stock option that she received from a public company. In this case, why she doesn't claim it is because she has, at the moment she exercised the share she didn't sell, and she holding, and that's why we include the value is less than ocean price. To finish, to conclude with the net income incidentally, we have the same amount on the minimum income from section C, so also we include other credit that she can use for the tax, for the basic tax at the end of the 2016. Thank you, Sandra.
Hello, my name is Faiza and I want to continue with the parts that we haven't included in our calculation. We understood that Mrs. Dalby has detailed expenses, amongst them are EI premium, CPP contribution and federal tax withheld from her gross salary. We did not include those amounts in our taxable income because they are credits and she can claim them as a deduction in credits parts. There is also a payment to United Way that is not eligible for a deduction because she is not a first-time donator payer. She also has child expenses which she is eligible to claim them as deduction in a certain condition. Which is not the case here because the definition of these expenses is not applicable here. But if anytime she has any childcare expenses, like those expenses which pay to the third party to take care of the child, like for example payment to daycare school, camp, like that, she can claim it as a deduction because her husband is disabled. So although she is a higher income parent, she can claim the deduction in her income tax. Also, two of her children are eligible. One of them because she is less than 16 years old, and another one is because she is disabled. But at the moment, these expenses that she has declared is not in the definition of childcare expenses, so it's not eligible here to deduct. There is another issue that we want to recommend Mrs. Dalby is about her stocks he has. We recommend her to don't keep those stocks for a long time because she has to pay the taxable benefits for stock options, and if the stock price drops, she can, still liable for the benefits. So it's her own, it's for her good to just don't keep those stock for too long time. Another recommendation we have for Mrs. Dalby is she has a good income, so why not she contribute in RSP plan? It's a registered retirement saving plan which allows her to deduct from her taxable income. This money will save and grow without necessity of paying tax. And whenever she wants to withdraw from this amount, she has to pay the tax. So it's the good savings reduce her current tax and allows her money to grow without any tax payment. Another saving plans she can use because her family situation is disability saving plans. She can use this money for the future of her daughter because she's disabled. It's not deductible for the income purposes, but it's a good saving plan because she can put her money there and it will grow without necessity of paying any tax. So that was our conclusion about her tax situation, and thank you so much. Have a good night.